This video aims to teach some financial accounting basics. Let us try to understand what is accounting. Accounting is a business language. It's a language where we communicate the financial transactions that happen in business. So we can say it is a sort of language we use to communicate all the economic transactions, all the economic activities that happen in a business. We can understand accounting from this. It involves following steps. First, identify the economic events that occur in a business. Economic events means those transactions which involve transfer of money, goods or services between two people. So we are supposed to identify the economic events and record them in business. Next, we are supposed to communicate these accounting reports to our users. By users, we mean those people who have direct or indirect interest in our business. For example, people who invest money in our business, people who supply any sort of goods to our business, or the employees of our company. So, in short, we can say that accounting is identifying the economic events, recording them, and communicating these reports to our users. Now let us look at some of the accounting terms. Now first, what is an account? Account is a brief history of financial transactions. It is a statement where we record all the financial transactions that happen in our business. You can see here I have given an example of how an account looks like. Account has two sides. One side is debit and the other is credit. Debit side means the left hand side of account and credit means the right hand side. Now we will look at some of the other accounting terms in our business. Okay. So what is meant by transaction? Transaction means those activities which involve transfer of money, goods or services between two people. There are two types of transactions: cash transactions and credit transactions. Cash transactions are those transactions which involve cash in any form. If we make payment, cash payment, or we receive cash, then it is called a cash transaction. Credit transactions are those transactions where cash is paid or received at a later date. For example, if we buy something from other business and we pay them at a later date, then it is called credit transaction. Similarly, when people buy from us and they pay us at a later date, it is called credit transaction. Now let us look at assets. Assets are the resources a business owns, or we can say that assets are the benefit business gets. It can be in the form of cash or any other benefit which business gets. For example, building, machinery, furniture that is used in business. So we can say assets are the properties business owns. Assets are of three types: fixed assets, current assets, and fictitious assets. Fixed assets are those assets which are held by business for long term. For example, building, vehicles, machinery. These are called fixed assets. Fixed assets can be tangible or intangible. Tangible means those assets which can be seen and touched. For example, building, car, vehicles. These are all tangible assets. Intangible assets are those assets which cannot be seen and touched. For example, brand, license, copyright, trademarks. These are all intangible assets. So, fixed assets are those assets which have a physical existence. Tangible fixed assets, they have physical existence, and intangible assets, they cannot be seen and touched. Current assets are those assets which are held for less than 1 year. For example, cash, receivables in case of credit transactions, then inventory or stock of goods held by a company, they are all current assets. So they are the assets which are there with the business for short period. Hence, they are called current assets. Fictitious assets, they are those assets which do not have real value. For example, if we prepay our bills, then they become our prepaid expenses, which are called fictitious assets. So they don't have a real value. They are not actually giving us any sort of benefit, but they are reducing our expenses in the next month. Hence, they are called fictitious assets. Now, let us look at liabilities. What is a liability? Liability is the amount that a business has to pay to the outsiders. So, we can say that liability is the responsibility of business or the money business has to pay to outsiders. For example, if a business takes bank loan, it has to repay bank loan in couple of years. If it buys goods on credit, then it has to make payment to those people from whom it has purchased goods. So this is liability. Liabilities are also of two types. One, short-term liability, and one is long-term liability. Short-term means that liability is to be repaid in short term. Mostly it is less than a year. For example, if a business has taken bank overdraft or it has to make payment to people from whom they have purchased something, and long-term liability is to be repaid in long run. For example, the loan taken from bank is repaid in couple of years. Hence, it is called long-term liability. So that's in this video. We will look at other accounting terms in our next video. Thanks for watching this video.